What's up guys, it's Mr. Fit to Flourish, and today I'm going to talk about how to set stops. So we already talked a lot about how we enter plays, and I'll show that one more time real quickly, but I really want to talk about how to set stops because people are always asking me, hey, what's your stop? What's your stop? Well, it's really just a Wall Street stop. What is a Wall Street stop? So if we look at this play here, this is a downtrend. So we would enter short, meaning that we would get puts. So we would be betting that the stock is going to be going down. This pink line here is the 9MA. This yellow line is the 20MA. Whenever the 9 gets below the 20, then we know we have a very bearish situation. So a lot of the time I like to enter on a trend bar. We talked about this in how to enter a trade. So I enter after the trend bar closes one tick below, so on the next candle. So this is going to be my trend bar. I'm going to put that in here, trend bar, and you enter one tick after the trend bar. What is a trend bar? It's a bar that is big and contributes to the direction of the trend. Okay, non-trend bars would be these tiny little bars here. These are non-trend. You don't enter after these. They're too small. They don't tell you where price action is going to go. Okay, so where do we enter? We would be entering right here. I want to make this really big so you can see it. We'd be entering right here after this bar closes and this bar forms. We would enter here. Now, we know entry. We know entry. Well, so if you enter one tick below the trend bar, the Wall Street exit is typically one tick above. I'm going to make this pretty bright so you can see it. That white line. So one tick above that bar. That would be my stop. Now, why would that be your stop? Let's think about this. We have to think about this logically. We don't just go because, oh, well, Wall Street stops. It's just a rule that you just stop one tick above, you enter one tick below. No. Think about this. Why do you even enter one tick below? You enter one tick below because that's saying that this trend should continue. So I'm going to enter if it continues down. And then the stop being one tick above tells me, listen, we had enough selling pressure to send us all the way down here. This is a big red bar, showing me there's a lot of selling pressure. Well, when you set stops, you need to be setting stops in areas that show you that the trade is going to be going in the other direction. What do I mean by that? Well, if we sold all the way down with that big red bar, then that means that there's a lot of selling pressure. Well, if there's a lot of buying pressure, then it's going to overtake all of that selling pressure that just happened. In order for that to happen, we would push all the way up past where we started from the sell, which is why we set that stop one tick above, because if we end up moving all the way back up here, that's telling me that this stock is going to end up moving all the way back to the upside. There's enough buying pressure to send the stock moving back up. So ideally, the stock should not end up coming up above this. How do I set my stops too? So I set my stop one tick above, and then if we have a bar close above this, then I'm out of the trade. No matter how small or large the loss, I'm out of the trade. You need to stick to your stop. Okay. Now, sometimes you might get a wick. You might get a wick hit this level. In that case, I'm staying in the trade. Okay. Sometimes algorithms will understand where your stops are, will buy the stock back up. Excuse me. We'll buy the stock back up there, or we'll manipulate the stock price back up before actually selling off. So as you can see, even here, we get massive wicks. And these wicks are testing these MAs, testing key levels. So we get these huge pushes up, right? But then selling pressure ends up pushing the stock back down. And then we get a pretty nice sell-off. Okay. Now, if we look at AMD, I made some call outs today on AMD, and I had some people ask me, "Oh, what's the stop? What's the stop?" Right? So I entered pretty prematurely on this double top here. We did have a neckline here and a neckline break, but I entered prematurely up in here, made a ton of money there. But again, this is our signal bar. So I would enter one tick below after the formation of this bar. Make this a little bit bigger so we can see. Now this is a pretty large bar. Okay, a pretty large bar. So if I set my stop way up here, one tick above the bar, that'd be a little bit too big. Okay, a little bit too wide of a stop. It's like a $1 bar. Typical trend bars on AMD are about 60, 70 cents. Okay, this is about $1 and some change. So what I like to do is I'll use a Fibonacci retracement. So I'll measure the length of that bar, and then the bar should not, or price should not come back higher than this 0.618 Fib. So that's what I like to do for my stops on larger moves. So what I did was I set my stop here, 147.74. So ideally, price should not come back up more than 50% of the bar anyways, because that would cause, that would show that there's a lot of buying pressure. But since I know about the Fibonacci retracements, should not come up more than 0.618 of the way up. So I set my stop there. Again, what's the important thing about this? You might be like, oh, well, that's kind of weird. Well, your trading can be kind of weird, okay? But what you need to understand is price action. So all I'm saying with these stops are there needs to be an area on the chart that you know if price starts moving in that direction and gets past that, then you need to get out of the trade, because it's telling you, it's literally showing you there's too much pressure in the other direction and that your trade is wrong. You're wrong about your thesis. So if we were moving down, and I think this is going to continue down, which it did, price never came back up. But if price were to come back up, if we ended up coming up this high and closing this high, I don't care if a wick hit this and then it ended up selling back down, then we're good. But if we had bars close above this level, I know for a fact we're probably going to be moving back to the upside, and we have enough buying pressure to send us higher. So I need to take the loss. Okay, I need to take the loss. Now we can do this also in a bullish direction. I know some people would be asking now, like, oh, well, I like puts. Okay, I like puts. But let's take a look at this in the bullish direction. So we just had a pretty massive sell-off. We get to this sort of a triple bottom here. And let's just pretend that there was actually a previous bottom in this area. So let's just say this is a key level. It actually might be. Let me turn on the daily ATR. Yeah, it looks like we're bouncing off of a key level here. But anyways, let's make this pretty big. Let's say you want to enter on this bullish engulfing. So this is a bullish engulfing bar. And what do? You enter one tick after a nice trend bar. So this is a nice upward trend bar. So we're going to be going long. We're going to be looking for calls, or we're going to be buying. Okay, buying. So I'm going to enter here, one tick after this bar closes. So where would I set my stop? Well, I'm going to set my stop one tick below my entry bar, my signal bar. So this is going to be my stop. Okay. And what did I say about stops? When you set a stop, you need to respect that stop. So if it needs to also give me an indication of, hey, well, if we get past this level, then the stock is probably going to continue down. It's probably not going up, because right now I'm getting in because I think that we're going to be moving up. So I'm getting in because I think we're going to be moving up. I'm going long. But if the stock starts to move down and closes below this low, then there's enough selling pressure to cause all of this buying to just kind of be eradicated, to go away. Okay, there's enough selling pressure to push us lower if we do close below this level. Okay. So the most important thing to understand with stops is the stop needs to be an area on the chart. You don't have to do the Wall Street stop like I just showed, or the Fibonacci retracement. If it's a big bar, you don't have to do that. The stop needs to be an area that it allows the trade to breathe, but it tells you that if the trade is going in the opposite direction, you need to get out of there. It's an area on the chart that you know that you were wrong about your thesis. Okay, if you think it's going up, but it starts moving past this level and it closes below that level, get out. If it wicks at that level and then creates a huge wick, a tail, you're fine. A lot of the time, it'll end up coming back in the direction. It's just algorithms trying to push you out of a trade. But the one thing to remember is that good trades just go. So if you have a good signal bar, then the trade should just keep going. It should just keep going. It shouldn't even wick back down, or there should be no downward movement if you think it's going to be going up and you get in. Good trades just go. So just keep that in mind, and keep that in mind about stop losses. Okay, a regular stop loss is just one tick below your entry bar, and yeah, it should be an area on the chart that tells you that you were wrong about your thesis. That's the most important thing to understand about stops. It's Mr. Fit to Flourish. Thanks for tuning in, and I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance,